Welcome everyone to today's webinar, Museums and Performing Arts Update, and how the impact of the new FASB guidelines affects museums. So we're going to go ahead and get started. I do want to cover a few housekeeping items. So I want to make sure that you know how to maximize and minimize the webinar pane during the presentation using the red and orange arrow buttons. During the webinar, we definitely encourage you to ask questions. In that same webinar pane, you'll see a questions box that you can use to type in your questions and click submit. Our presenters will answer those questions throughout the presentation and at the end as time allows. And I definitely want to make sure everyone has good audio quality. So if you are using a telephone, make sure you select the phone call audio option. If you're listening through your computer, select the computer audio option. Now I want to introduce our presenters. Today we have Dean Quiyambo. After spending 12 years as an auditor, Dean transitioned to be our Chief Relationship Builder. He helps numerous private, public, and nonprofit companies address their tax, audit, and outsourced accounting needs. We also have Matt Gard, who is a partner in Armanino's audit department and leads the firm's museum and performing arts practice. He works extensively with clients in the nonprofit museums and performing arts sectors nationwide. So with that, I'll kick it off to our presenters.
Great, thanks, Marie. Yeah, I'll go ahead and get started. Overall, the presentation, we're going to cover a couple of the key new accounting standards that are impacting not just nonprofits, but all organizations. But really what we wanted to do was pinpoint how these impact museums and performing arts organizations. As Marie mentioned, I lead that practice here for Armanino. And have helped a number of clients early implement some of these standards. So I'll share some examples, some learning and pain points that we've identified over the years. And really what I want you all to have taken away from this is some key action items, what you can do now to implement these items and what needs to be done here in the next year or so, because you've probably been hearing that these are coming. Well, now they're just about all here. Some you'll have to implement this year and the rest will be next year. So we're now here. It's very important that we understand what needs to be done to implement it and what steps you as a museum or performing arts organization needs to do to have a successful implementation.
Well, Matt, and I'm glad you bring it up because right now when you talk about nonprofits, it feels like we have a trifecta of change coming about specifically related to nonprofits. And I love that we're going to talk specifically how it relates to arts and museum organizations. But there's a lot of change and it's all coming here very shortly. But number one, I feel like you're going to talk about collections and we're still going to talk about some of the liquidity and some of the reporting changes coming up as well, right?
Yes, correct. Well, we'll get through all that. So to start, the first one, and the reason I wanted to bring this one up is it never happens that the FASB actually issues a standard that's applicable just for museums, right? Everything typically impacts all nonprofits, for-profits, etc. Well, actually here in 2019, FASB issued a standard just specific to museums or arts organizations that have collections. And it's really small, but I wanted to bring it up because it is here for those of you organizations that may have a collection. FASB updated what that definition of a collection is. So if you're looking here at the slide, the first couple points are the same as it's always been, but where there's change is on that last point, where it says that the organization policy requires the use of proceeds from items sold from the collection be used to acquire new collection items. That's where the definition stopped in previous GAAP. This new standard says that those sales of collection items can actually be used for either acquisitions of new items, or now it can be used for the direct care of existing collections, or both. So that is a new piece for it that allows organizations to use those proceeds from sales of collection items, not just to acquire new items, but also to care for their existing collections. And the new standard also requires that those organizations disclose their policy for that. Are you just going to use it just like you have in the past for new collection items, or are you going to use some of those proceeds for direct care of existing collections? And if you are, what does direct care mean to the organization? What types of items will you be using those proceeds are? Again, small, it probably won't impact all of you here on the webinar, but something that's new and specific to museum organizations. The next one's the big dog, right? Everyone's talking about revenue recognition, for-profits, nonprofits, everybody. when we look at it, what types of organizations will be impacted, 2 of them are definitely museums and arts organizations. And this is a 600+ page standard, but I'm just going to pinpoint what I think are some of the key changes that I've seen in the museums and arts space, and what you should be considering moving forward as you implement the standard. This is one that's going to be for calendar year end. You're in the year of implementation. You'll have to implement this next year. For those June 30th year ends, you have a few months until you're in that year of implementation, but it's obviously fastly approaching. And so the types of revenue that are exempt, I did want to point out that contributions, right? There's specific accounting rules for contributions, for government contracts, foundation grants, etc. But what I see as some of the key issues where this comes up for museums or arts organizations is in the membership area, right? Most of our museums or arts organizations have a membership program that gives the members certain benefits. And we'll talk about how the revenue recognition rules change under those types of membership programs.
Yeah, that's something that we've been hearing a lot about, and I'm glad we're about to break this down through this 5-step process. Why don't you walk us through this, Matt?
Yeah, so what the standard requires is a 5-step process when you look at any contract with customers, right? First, you identify what that contract is. You identify what the obligations you have as an organization under that contract. You have a transaction price, right? What are you receiving under that contract? Then you also have to allocate the transaction price to those performance obligations, right? A membership might have multiple performance obligations that you'll have to allocate your transaction price over. And then it requires the recognition of revenue when or as those performance obligations are satisfied. So if you do have multiple performance obligations under that membership, you will recognize revenue when each of those obligations are satisfied, not just on an annual basis, perhaps. So let's take a look at an example of what that might look like, right? So here's a museum membership program. The museum's charging $60 in annual dues. As part of that membership, they receive these different benefits: monthly newsletter, a discount at the gift shop, a free admission, parking spot. And so what this museum has to do is, for that $60, well, what's really the value of those benefits that the members are getting? And so they've identified different value for each of those obligation items. You'll see that adds up to about $75 of value. So the customer is paying $60, but it's getting $75 of value. So when we talk about these are the different performance obligations, we now have to allocate that $60 transaction price to each of these performance obligations so we know how to recognize the revenue. We look at the next slide. This is how you would allocate that, right? So the value of the monthly newsletter was $30 of the overall $75 of value, 40%. Take that 40% by the $60 of actual membership dues that will be paid. So you, as that monthly newsletter, as you fulfill that obligation, you would recognize that specific obligation once you've performed it, right? It's not dependent on the other obligations within this membership. Each individual obligation would be recognized separately.
So Matt, what I'm seeing here is this all makes sense logically, but from a administrative revenue recognition type of perspective, this is kind of a nightmare.
Yeah, I mean, there's a lot going into it, a lot that our organizations have to consider. Ultimately, what I've seen in most of my clients is we'll do an assessment of what this might look like, kind of breaking this down and looking at historical averages. And on a lot of them, we've ultimately determined that really the actual revenue recognition under this approach as compared to what they were doing in the prior year was not material. And as such, some of them have continued to recognize the way they always have, but it's still very important that because of the new accounting rules that we're comfortable that the approach is not materially different than this approach. So that's something that you'll be sitting down, making sure you take a look at with your auditors, you do that assessment, and it may be material and it's something you'll have to look at and, what's the best way to track this? Again, you can look at historical trends for how to recognize these different items. But it's something that each organization will have to take a look at and determine what that impact is to their financial statements.
Well, that's good to hear. It's really good to hear that as people are diving in, they're finding out that it's not material. But yeah, because you're right, this sounds like more work for sure. At least they got to do the analysis.
Absolutely. So I see this with my clients. This has kind of been the big one. You know, if your ticket sales, nothing really changes, right? You have that performance obligation, you put on that show, you recognize the revenue, right? There are some, if you have revenue streams that do have, you know, multiple deliverables or different elements, you know, outside of the membership that we've talked about, those are the types of contracts you need to look at, right? And do the same type of analysis. Is there any change here that's material and that we'd have to look at accounting for differently? So moving on to the next big issue is leases. This one's about 2 years out, but it's still coming, you know, fastly approaching here. And this is one that should impact every organization that's on this webinar, right? All the organizations have leases, some may be larger than others, but it's something that each organization will have to take a look at. So what this standard does, this part doesn't change much, but it just clarifies the definition of what a lease is. And I think we all understand what a lease is, right? You have the right to control the use of the property or equipment for a period of time in exchange for consideration. And then it further clarifies what's control. You have the right to substantially use all the economic benefits, and you can direct the use of the asset. So all the different leases that you guys have, that all makes sense, right? You might have copiers, you might have facility leases, you might have equipment leases, et cetera, that would all meet this definition of a lease. So let's look at how you currently account for leases versus what it's going to look like here in another year or so. So under current lease accounting, I'm sure everyone's familiar, you have operating and capital leases. There's currently 4 criteria to determine if it's an operating or capital lease, right? Operating leases right now are not on the balance sheet at all, right? It's a disclosure only type item. So if you meet the requirement that it's an operating lease, you just have a disclosure. We have these leases, these are future payments for it. But if a user is looking at the balance sheet, there's nothing there. They don't see it. You'd only see the capital leases that are on there. Under the new lease accounting, you still require the classification as either, and they've changed some of the language, no longer a capital lease, is a financing lease. You still have to do that same assessment. Okay, do we have now a finance lease or an operating lease? The big difference here is that even if it is an operating lease, you will see that on the balance sheet. It will be recorded as a right to use asset. You have the right to use whatever asset you're leasing, and you have a lease liability of that same amount that you'll have to be paying off over time. Really, this gives the users of the financials a clear picture as to what those obligations might look like. It's on the balance sheet already recorded there. And like I said, it's a right to use asset and liability. So why do we still, if everything's on the balance sheet, why do you still have to determine if it's a financing or operating lease? See that here on this next slide. The finance or what's currently a capital lease, basically it's going to be the same as it always has been in the past. It's just some of the descriptions will be changed to the right to use asset and lease liability on the balance sheet. You'll amortize that expense on the income statement as well as the interest expense as you reduce your liability. And on the cash flows, it's principal financing, the principal repayments of financing activity, just like it always has been. Under operating, it's a little bit different, right? So now you have the right to use asset on the balance sheet, you have the lease liability, but you don't have amortization expense or interest expense. You have one single lease cost recognized on a straight line basis for your operating lease expense, right? So it's a little bit different, whereas under financing, you're amortizing into amortization expense or interest expense. This you'll have one operating lease cost, and it's going to be recognized on a straight line basis over the lease term. And any payments under those leases are operating activities on the cash flow statement. So the biggest thing
Matt,
here.
Now, when you're looking at this real quick, sorry, could this affect, we're talking about putting some liabilities on the books here. Could this affect any kind of debt covenants or bond covenants or any kind of, compliance type of measures or ratios?
Yeah, absolutely. If your debt covenants have a lease component, a liability component where the calculation is based on a liability, you're going to have more liabilities now than you were used to when those covenants were set up. So this is something, as an action item, you want to take a look at your debt covenants. Is this going to impact anything? If it does, what is that impact? And is it something you need to go to your banks or debt holders and determine, we might need to restructure how these covenants look because we can no longer meet them under this new accounting standard. So definitely something that you want to be proactive in that, right? You don't want to, in the year of implementation, be as part of the audit and all of a sudden you're failing a debt covenant because you didn't consider this. This is something to be looking at here over the next year or so and getting those changed if need be. Just a couple quick other things on this. If it's a short-term lease, less than 12 months, then you don't have to put it on the balance sheet. It's very short term. If there are optional payments, you would have to consider those as part of this calculation of what your leased asset and liability might look like if those options are reasonably certain of being exercised. I won't touch on this too much, but the standard does require some more enhanced disclosure items than you might have seen in the past. And like I said, this is not going to be effective this next year, but for all organizations, fiscal years beginning after December 15, 2019. So calendar year ends 2020 or 2021 for those off calendar year ends. So I think the biggest takeaway here and the biggest impact, if you just have copier leases and some small leases, it's not going to be that significant, the accounting change, right? Small dollars. But if you're leasing your facility in over a long period of time, right? Those all of a sudden become big numbers that come onto your balance sheet. So important to start aggregating all the leases you currently have or are expected to have and start determining the impact, how those will impact your future, your debt covenants, how it'll impact the balance sheet, and start doing that exercise of what that calculation might look like. And then the last one we're going to talk about here is the financial statement reporting changes. And this is the most near-term one because it's in effect right now for everybody, right? If you're a calendar year end, you may have already started this implementation process or you may be done with it. June 30th are coming up right around the corner. We'll talk about some of the key items here. And if you aren't ready for them, what you should be doing here in the next several months to get there. So this impacts a number of different items, and we'll talk through all of these. Kind of the simplest is the net asset classification, and just changes some of the verbiage that you might be used to. So in the past, we've had unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets, depending on donor intent. The new standard collapses those down to two, right? And you can kind of see from this example here how those get collapsed, right? Temporarily and permanently restricted net assets combine into now being known as net assets with donor restrictions, whereas unrestricted net assets are now called net assets without donor restrictions, right? I think the intent behind this was to try to make it easier for people using nonprofit financials that might not be familiar with them, right? What's temporarily, what's permanently, what's unrestricted? Well, now it's either you have net assets with donor restrictions or they're without donor restrictions. I think that's a little easier for people to understand. So again, this is pretty simple, right? It just rolls up two items into one and renames one of the items. Our recommendation is not to really change anything you're doing as far as underlying accounting or chart of accounts or anything like that to change it. You still do, and I'll show you an example here in a minute, have to know what's temporarily restricted in nature, what you can actually use here and once a purpose or time restriction is met versus what's endowment in nature. So those will still have to be tracked separately. They'll just roll up as one item on the financial statements. And so in an example of that, here's your statement of financial position or the balance sheet, right? And looks probably fairly similar to what you've seen in the past. The only change, you go all the way down to the bottom of the page, is the net asset section, and now those have been renamed, right? There's only two categories instead of three, and they've rolled up with the new descriptions. Just one other thing here I wanted to mention under this with those net assets with donor restriction, it does change if you're an organization that has underwater endowment, meaning the actual fair value of the endowment assets is less than what the donor gave you. There is a change here, whereas that used to be reflected in unrestricted net assets. The organization would kind of have to borrow from unrestricted to replenish that underwater portion. This new standard, any underwater endowment activity will actually flow through with donor restrictions. So that's a bit of a change there. Endowments are obviously donor restricted items, so the FASB thought it made more sense to reflect all that information in the with donor restriction category. Another example, like I mentioned, where you do have why you have to still track those temporarily restricted items versus those endowment type items is because you'll have a footnote. In the past, you might have had two separate footnotes for permanently restricted and temporarily restricted items. Now you'll have one footnote with net assets with donor restrictions that, the top one talks about any purpose restrictions, right? So these are temporarily restricted for a purpose restriction. The second item is time restricted, right? You have to wait to receive it before you can use it. And then lastly is that investment in perpetuity, the endowment, right? Those are what we've seen as permanently restricted. So it still needs to be broken out here in a footnote that rolls into what's on the balance sheet. So that's why we still need to track these items separately, even though they do roll up as one item on the balance sheet. Then just quickly, just a couple other examples. How you have an endowment footnote that shows your endowment activity. In the past, you've seen the three columns to show the different items. Now you're down to 2 items. Pretty easy changes here. The last 2 things I just wanted to mention on here is any board designated amounts. In the past, you only had to disclose if you had board designated endowment. Now you are required to disclose all board designated net assets. So if you had board designated assets for, an upcoming exhibit or for facilities or whatever the case may be, all these different items will now have to be disclosed as, the board has designated these assets for a specific purpose. Whereas in the past, you did not have to disclose any of that. The last item on here is they've changed how the expiration of restrictions on capital projects. So in the past, you had an option to, if you had a capital project, right, all those dollars are temporarily restricted for that project. There was an option that you could release those restrictions basically over the life of the building. Let's say it's a building you constructed, and release it just kind of similar to depreciation, release it, once a year over a 40-year period. That's no longer allowed. You now have to release all those restrictions under once the project is placed into service. So for those of you that are under the other approach where you're releasing it annually, something to take a look at. I have one large performing arts organization that is doing it that way, and they're going to have a big reclass from their temporarily restricted into unrestricted, or they're without donor restriction this year because of this change, and they're determining how they want to communicate that to the users of the financial statement. So if you are under that old approach, make sure you're considering that now. And then lastly, just show the income statement under the 2-column approach. Again, pretty simple items here. Okay, expenses. There is a change with how expenses are presented. In the past, you just had to present your expenses by functional class. You did not have to show natural class in the financial statements. The standard now requires that they both be provided by both functional class, so program and supporting activities, as well as by nature, so salaries, benefits, occupancy costs, etc. And they both have to be in the same spot in the financials. So whether it's a separate statement or in the notes, it just has to be presented together. So if you're already doing a statement of functional expenses in your financial statements, you're covered, you're set there. If you're not, this is something that might be new, but you're all doing this already as part of your 990 reporting, right? You have to do that. So our recommendation here, but some of my organizations I've worked with, they would do that as part of the 990 after the audit's done, right? So some of our organizations are kind of moving this step up, preparing that 990 schedule by function and natural class as part of the audit, and presenting and providing as part of the audit so that we can fulfill this disclosure requirement. So again, it doesn't change anything, but it just you may want to consider when you're preparing that schedule and whether you need to prepare it as part of the audit versus after the audit as part of the 990 process. Then the last item on here is investment return. There's always question is, okay, well, where do I put investment expenses? Is it in the expense section? Is it net against investment income? This clarifies it. It should be net as part of your investment return, and there's no longer the option to include it as an expense. So an example of what that might look like, we have your natural class running down the page, and then your columns with your functional expense classes, right? Your programs, your G&A activities, and your fundraising expenses. Statement of cash flow, I'll move through really quickly because there's really no change here. It just gives nonprofit organizations the option to present either the direct or indirect method of cash flows. 99.9% of my clients present indirect method, so continue to do that if you're comfortable with it. But if you do move to the direct method, you no longer have to do an indirect reconciliation like you used to in the past. All right, and then the last one, and probably the biggest impact that's going on now is liquidity. Nonprofits will now have to have in their financial statements information on liquidity and how they look at liquidity. Right, and I think that here's the objective of the project is to give the users of financials a better picture of what an organization's liquidity looks like. Right, if you're not familiar with nonprofit accounting, it can be tough to use those financials and really see what an organization's liquidity position looks like. So this is to add more clarity on what that looks like. And Dane, I'll kick it to you because I know you always have a story of an organization that has big assets, big investments, big cash balances. Looks like they have great liquidity, but when they have to implement this, might not look so great. You want to tell that story?
Yeah, that's exactly right, Matt. Is when you look at the face of a financial statement, you see that balance sheet, you see big cash, you see big investments, and then you find out that all of those investments are tied up either in net assets with designations, right, in your endowment, or maybe they're tied up in board designations, or maybe those assets, and we see this right now, Matt, we see a big trend in nonprofits that are investing in alternative investments that are not readily available to be turned into liquid assets. And so all of a sudden, maybe they didn't see it coming, maybe you're not ahead of it, and you're going to show a position that even though your balance sheet is very strong, your liquidity is not. And this is an area where your CEO, your chief advancement officer, you guys all want to be on the same page, your board, your finance committee, and say, what is a message that we really want to go out to and tell the community about our liquidity?
Great. So what this requires is disclosure of how the organization manages liquidity. What's your story? What's your liquidity look like? How do you meet your expenditures coming up? There'll also be a table of the actual financial assets you have, and what that time horizon looks like for how you're able to use those. And then just some other qualitative information about how you manage liquidity. What's your strategy? Do you have a liquidity policy, and what is it? And how you determine the time horizon for managing that liquidity. Just a couple, and Dean mentioned a few of these, and I won't touch on all of them, but these are different things you need to consider that you may think are liquid, but then they're actually not, right? There may be assets that you cannot convert to cash for whatever reason, and then there's some examples there. If donor restrictions are on them, they're not liquid. You can't use them for operations, right? There's some sort of restriction on them, so you have to account for those. Contractual and legal restrictions that would have to be accounted for. And then the last one that nobody really thinks about, but if there's internal limits by a governing board, right? So we talked about some board designated endowment, for instance, earlier. Understood that those can always be released, but at the current point in time, there isn't a limit on those, a restriction or designation that they can't be used. So you have to at least disclose that that's the intent at this point, and that they can always be released, but right now that's not the plan. People always forget that because they are board designated, not donor restricted. The other thing I wanted to mention on here is, we all know what your financial assets might look like, but you also want to talk about what resources you might have, right? If you have a line of credit that can be accessed, if you have an unanticipated liquidity event, you want to make sure that disclosure is in there to show that you have this, access to cash as needed. The other item on here is appropriations, right? If you know you're going to be appropriating a certain amount of dollars from the endowment for operations, disclose that, right? We have this additional cash coming up that we'll be able to use in our operations. So just some best practices here is really making sure you understand what your liquidity policy is and making sure everybody's comfortable with that. What lines of credit do we have? What potential board designated funds that we have that we could use if needed, because we'll want to disclose all those types of items. So I won't read all this. I just tried to bold a few key aspects, but this is a sample footnote from one of my museum clients, right? So it talks about at the top about how they manage liquidity. It goes through to talk about some of their investments that are restricted or subject to certain lockup restrictions, right? So that they can't use it right now. It talks about some of their investments are endowment or quasi-endowment, board designated, that can't be used right now. And at the bottom, it talks about that they have lines of credit that they could be used upon if they ever needed to. So you want to just have all that information about how an organization looks at liquidity and what might impact its liquidity as part of this footnote. Quantitative, like I said, will also have to show the actual numbers that tie back to the balance sheet. Right, so here's an example. We have all these financial assets. We have cash. We have future receivables. We have investments. We might have a trust. So we have, assets of over 31 million on here, but a lot of them are tied up, right? So you have long-term receivables. Well, you're not going to be able to use that in the next year. Investments might not be redeemable. They may be in partnerships or real estate or whatever that you can't access. You'd have to back those out. Again, board designated or endowment investments would be backed out. So this goes back to my original point of why they're implementing this, right? If you just looked at the balance sheet, wow, 31 million of financial assets looks like they have really strong liquidity. Well, if you actually look at all the different designations or restrictions behind it, it might be half of that, right? That's actually able to be used in operations over the next year. So just highlights kind of the importance of this footnote and why it's being required. So this transition method, this is now, right? Like I mentioned, if your calendar year end, you're in the process of implementing it, June 30th are coming up right around the corner. So this will be effective for everybody here soon. If you're using 2-year financial statements, you do have to adjust some of the prior balances to account for some of the changes. But what you do not have to adjust, liquidity, you only have to show 1 year of that. You don't have to go back and try to determine what your previous liquidity was. And that functional expense presentation I mentioned, only required in the year of adoption, the 1 year in adoption, you do not have to disclose 2 years of that. Just last thing on this, just kind of general takeaways is on liquidity. Making sure you have a policy and a footnote, start crafting that now, right? That's something you're going to want to get in front of. This tells the organization's liquidity story, and it can make a big impact on donors or debt holders or whoever's using the financial statements. And so you want to make sure you've spent time on this, that it's been reviewed by the audit committee and potentially the board, and making sure everybody's comfortable with what that policy and footnote look like. So it's something you should be getting with your auditors on to get some help with, some sample language perhaps. If anybody needs some templates, we have them, so please reach out to me and I can help with that. The other thing was on the functional expense. If you haven't had a schedule of that in the past, something to look at and making sure you can use some of that 990 reporting. We don't want to duplicate anything that you don't have to do, but maybe bump up some of that work so that it's prepared and ready for your audit so that it can be put into the financial statements. And then the last thing, and I kind of glossed over a little bit, was just the board designated items. This is one that there might not be a lot of good documentation on or that goes back, quite a ways. You'll know how to disclose all those different items, and you haven't in the past. So making sure you understand any assets that have been board designated for a specific purpose. Make sure we get all the documentation and everything behind those so that we can disclose them in the financial statements. So I know I threw a lot at you and run a few minutes over, but I really wanted to pinpoint some of the key items, some key takeaways, making sure that everyone's doing those and is ready to have successful implementation of, these are some of the biggest changes to nonprofit accounting in 20 plus years, and it's all kind of coming now, and there's a lot going on. So Dean, any final thoughts?
Yeah, I think, Matt, you hit it on the head, is that just get out in front of it. This is just, all of these changes are all going to be stories that you and your management team is going to want to proactively tell to your donor base and your constituents. So get on the same page and do it together.
Perfect. And I want to thank everyone for joining us today. You will receive an email with today's recording and presentation within the next 48 hours. And like Matt said, if you guys have any questions, we know we threw a lot of information at you. You can email Matt directly. Thank you.
Thanks, everyone.